Like, okay, screw it. I lost a $500,000, whatever. I will fight till the end, still have 800 grand of mortgage. It is what it is. Let's fight. So the next segment happens, in my opinion. All right, so my personal opinion, Canadian real estate market will continue to drop, and we will see more drops and severe pricing, bankruptcies, insolvencies, and everything that brings our real estate market down. However, this morning I had a great conversation with a good friend of mine and a colleague for over an hour. However, this conversation goes back to 2018, okay? So at that time, he brought something up to me, right? And that was 2018. And he said that there might be a possibility of an equilibrium in price between the city and the suburbia. And at that time, I said, well, hold on a second, man. Like it almost doesn't make any sense because we all know that price is obviously connected to a community, to a desired location, and so on and so on and so on, employment and whatnot, right? So we know the AAA areas, B areas, C areas, and etc., right? So at the time, it didn't make any sense because how is that shift going to happen? However, during the COVID, during the pandemic, we have noticed so many things. So one of the things, obviously, the lockdown, they pushed a lot of things. And that created the equilibrium because it opened up the gates and the ability, right? What we were talking about. And then he brought something up that was interesting to me. And it was like we couldn't trade in a way we traded. So new things came up, right? Like electronic signatures, broker bay, like you book your showings and viewings through broker bay. We were signing documents. There's all these things that kind of all of a sudden made it easy to trade. On top of that, the industries made it easy for people to allow themselves to be outside the city. So it was that moment where people almost got fed up and they wanted to go to suburbia. So then that suburban areas, right, the cities, the towns, and everything in between made it happen, right? Brought up another good point. He said, like, look, his friend, which is a doctor, made all his calls through online and Zoom calls or whatever video calls, all the appointments, right? So he would drive in or come into the hospital whenever they had a big surgery and stuff like that. So it made the world open up, right? Wider from the borders of original AAA community in a town. So what happened? Now, like, obviously we had examples. I asked him, give me an example, right? And he said like Lululemon, right? So the Lululemon wear, sportswear and stuff like that. At a point of time, that particular brand with that particular fabric was number one, AAA quality, AAA pricing, right? So we're talking about Toronto being in High Park as a AAA location, kept the value, kept the price, kept the brand, kept the image, right? Same thing goes with real estate, right? Everyone wants to live wherever they want to live. However, when those gates opened up during the pandemic, other locations and other opportunities came to light. So it's the opportunity where people saw, and same thing happened with Lululemon, right? Like other companies like Nike, Adidas, Puma, you name it, came into that sport space and created the opportunity where someone can buy um, that product or a similar product for significantly less. And that created a jump. And then with that jump outside the city, those properties became extremely valuable and desirable and high price and everything else that comes with it. Now we're seeing the shift. I mean, the shift is from 2022. Now from an equilibrium market, right, where it was almost a better bang for the buck, but I have the ability to be outside the city. Now, when things are cranking back up to the original settings, I would say, or close to original settings, things are changing. And we were kind of debating and discussing it like as friends, obviously. And it was that interesting part because, you know, High Park still kept the price. Yes, some discounted price at the moment, 5%, 10%, 15%, depending where, right? People keep these properties for a long, long, long time. So maybe family traditions or whatnot. They're tearing them down, they're taking lines of credits, they're upgrading them as they go. But majority of the time they keep it. So with that, prices are more stable, okay? So outside that bubble, that triple A bubble, okay, like we took an example of High Park. Now, if you see Windsor, London, Paris, Woodstock, Welland, and I'll give you an example, Welland canals, okay, Niagara Falls, Grimsby, Stony Creek, Hamilton, right? All of these areas have seen the significant jump of 20, 30, 50, 60%, 80%, who knows, right? So that jump, like it almost, the value vanished overnight because there's no interest. And the example that I want to give you with Welland canals is at a time, I would say it was around the peak, and this is the next concern, my concern, like how I see the market rumble, okay? And uh, Welland Canals, they buy at the peak, 2,500 square foot detached home, somewhere in the ballpark of 1.25, $1.3 million, okay? So you see what I'm saying? That equilibrium, right? A little bit better product. At that time, you could have probably gotten in a market in Mississauga or Burlington, maybe not as a nice of a detached home, but much, much better location. However, now the same product in Welland Canals is somewhere in the ballpark of 850. Okay, so that's a significant drop. Let's say a drop of $500,000. Now, let's say you take a couple that, whatever, it's they own something, a townhouse, a condo, and they manage to gather $500,000 of equity because their property jumped. They wanted to switch a bigger property. They can work from home and all that stuff. Boom, they buy. So common sense, $500,000 down payment on 1.3, there's $800,000 of a mortgage. At that time, mortgage was lean, no problem, low interest rates and everything that comes with it, right? They work from home. There are no additional costs, no gas, insurance is less in some of these smaller towns, and they're living a better lifestyle. Now, in this shift, that down payment, literally, it's gone. That $500,000, it's gone or close to it. If they had to sell, there's commissions, there's transfers, there's land transfer tax that they will not gain back, and everything else that comes with it. So what else is the problem? Well, the problem is that all of a sudden you have a couple or a family that was building up for a decade or 2 decades, got to $500,000, invested over a period of 2-3 years, got shaved down to zero, and you have a family that is completely broke. They cannot make the next move at all. Zero, right? Why? Because they have no money. As simple as that. So now let's take it further. Now you have a couple that has next to no security, okay? Their pension plan is probably going to hover around $1,000 once they retire, if there is a pension when they get there. So they're around 40 years old. What are they going to do? They have to start from zero. They have to save. And let's do the math quickly. If they saved, let's say, $2,000 a month, which is a good chunk of money, right? Do you know anyone that saves $2,000 a month? Not many people do, right? But let's say they manage. So that's $24,000 a year, all right? So times that by 10, that's 240, times that by 20, that's $500,000. So it will take them up to 60 years old to recover their lost down payment, okay? So what's the solution? So right, all of a sudden, there a portion of families, Canadian families, that gained that threshold, that gained that down payment, that gained that money, disappeared overnight. That wealth, that gap of a century or 2 centuries is gone. It's finished. They're broke, right? And they cannot even recover on top of that. So that's the first problem. The second problem is we also touched that, like a friend of mine and me, we were kind of talking about that. It's the threshold of taxes, the income tax, okay? There are obviously different thresholds and all that stuff and the percentages and whatnot. So let's say this couple decides to stay in the home. Like, okay, screw it. I lost $500,000, whatever. I will fight till the end, still have 800 grand of mortgage. It is what it is. Let's fight. So the next segment happens, in my opinion. So when they had the original mortgage with your original terms at the time, it was low, right? They're probably paying $2,000, $2,400, $2,500, whatever the case is, okay? But it was lean, okay? So they could carry it. Now, when the renewals start and when everything shifts, okay, all of a sudden you are getting yourself into a different situation. And the situation, you need more money to pay for your mortgage and everything else. You probably have to drive to work. There's gas money and everything else, and the vehicles, you have to change them sooner, right? Because you're doing the mileage and whatever, right? I don't want to get into the quality of lifestyle, each way a couple of hours and whatnot. But let's say they manage to do that. What is the next move that they have to do? They have to make more money. So with making more money means declaring more money. If they declare more money, they might be shifted in a different tax bracket. The next tax bracket might affect, and generally does affect, majority of people. So check this out. Their candle is burning on both ends. Higher payments, higher cost, lost down payment, the next tax bracket up. So how are they going to win this particular situation? And this is only one family, right? So everything that I see in kind of like a nutshell, like talking to the builders, talking to developers, talking to people that want to see the opportunity. But I think at this time, it's not only about the opportunity, it's about not making the biggest mistake of their life, right? Because if you don't calculate everything, plus when you calculate everything to the last cent, plus the risk factor, and most people do not calculate that. Most people calculated on the way up when everything was good. Market is going up, no problem. If I do this, this, and this, I will get this. And it's given. It's almost predicted because people predicted markets for a long time. And nowadays, I've seen these sheets, okay, like the plans, the sheets, the visions, okay. I've even seen the money on the table, but they don't calculate the risk. And they say, if I do this, 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 that's the outcome. I said, why? you think if you demolish this and you do this and this house goes up and it will be $3.5 million, what if it's not? And they're like, wow, it's Oakville. Who cares? Could be Oakville, could be Port Credit, could be Hyde Park. What if this house at 3.2? Well, there's no profit then, right? So you see what I'm saying? It's almost becoming risky, extremely risky, and there are no visible guarantees in my eyes that things can change. So let me just touch on one more thing that's very important to me, and that is the boomers, the people that grew up 70s, 80s, 60s, that have purchased these homes, 30,000, 50,000, 80,000, whatever the case is. So that's one segment of the story. The second segment of the story is that majority of the white collar, okay, even blue collar, had some kind of a union, some kind of a security, automotive industry, tool and die industry, trucking industry. Everything was tied up to a secured retirement fund. So when obviously they are in the situation where their home always kept gaining much, much faster than the loss, right? Then the recovery is given, right? And my friend brought up an extremely good point. He said, like, look, the point of a home is to pay it off because that's the security, and the security is that it's your home and the bills automatically reduce much lower than having a mortgage. So the whole point is to get rid of the mortgage because that's the biggest chunk. I said, fine, fair point. And many have managed, right? From 60s, 70s, 80s, 90s, and onwards, right? However, they pay off the homes. They have money to live. If their retirement is 2,000, 3,000, 4,000, they can live. Today, how many people do you know that have a retirement, okay, of $5,000 a month? Zero. I know zero people, right? I know people that have 1,100. I know people that have 1,500. I know people maybe that have like over $2,000 that drove transit for some while, right? Or stuff like that, right? But not 5 grand, okay? I don't know. Maybe there are some police officers, captains, firefighters, don't know. But let's say that's the case. I give a retirement person $5,000 with a paid off home in Hyde Park, they will have a hard time because taxes are, $15,000, utilities are $500. So when you add everything up, like they probably will survive barely. But the new generation, this generation that's going through the biggest reset and will probably continue to feather down, right? They have no chance. Those people from Welland, they cannot recover. They cannot even save for their retirement. Okay, never mind. So what is it gonna be? I mean, I have no idea. So I think at this point the prices have to or must come to a point where they're 2, 3, up to 5 times annual income. Then we can have a vision, a picture, an investment opportunity for other people, right? Like people will flock, start investing, start building, start from scratch, start doing these things, taking that risk, but not that, an ordinary property is 9 or 12 times an income. I think that's ludicrous, right? So anyways, please comment below. I want to thank my friend. It was a great conversation this morning. This conversation started in 2018. I finally put it on video. So anyways, thank you all for watching. Please like, share, and subscribe, and I'll see you in the next one.